Hi, my name is Rajiv Rebello. I'm the Principal and Chief Actuary of Colva Actuarial Services. And today we'll be talking about how do I increase my risk-adjusted portfolio returns and minimize taxes as I plan for retirement. So this is a four-part presentation. And in this part of the presentation, part one, we'll be talking about how are stocks and bonds used in portfolio management. And this will be an important part because you really need to understand the role that these two play in traditional portfolio management in order to understand how you can kind of utilize various financial planning tools to maximize your returns, right, and minimize taxes. So we'll be talking about in later sections how stocks are more tax efficient and higher earning than bonds and how you can utilize that to your benefit. But in order to get there, we have to start with the basics, which is just understanding how stocks and bonds are used in portfolio management. So that'll be the focus of this part one of 4 of our presentation. I will link to the parts 2 through 4 in the description below. So let's just go over an overarching agenda for our presentation on how do I maximize risk-adjusted returns and minimize taxes as I plan for retirement. I'll just go over the different topics we'll be talking about in this presentation and what part of 4 you can find this topic in our presentation today. So the first subject we'll be talking about, what are the role of bonds in a portfolio? So that's going to be in part 1, and we'll just see that bonds provide stability. They're lower earning, but they also provide less volatility, so less up and down movements in your pricing. So if you worry a lot about monitoring your portfolio, that's kind of where bonds are, is they reduce the up and downs of your portfolio. What are the role of stocks in a portfolio? Again, that's in part 1, and we'll see that the stocks is where your main growth is of your portfolio, and it's very tax efficient, as we'll be talking about, especially if you're looking to pass on generational wealth. You can really minimize, the tax drag of your portfolio by using stocks or equity. In part 2, we'll be talking about why stocks are higher earning and more tax efficient than bonds. So that's really going to be of interest and a key part of this presentation. Again, that'll be in part 2. In part 2, we'll also be talking about the problem with retirement models and retirement accounts for high net worth clients and why traditional models over allocate to bonds, even though bonds are lower earning and not as tax efficient as stocks. So that's, again, a very important part of the section. We'll then be talking about in part 2, well, if bonds are so tax inefficient and lower yielding, why do advisors and target date funds increase allocation to bonds as clients get older, right? So why are they doing that if we know that stocks are higher earning and more tax efficient? And we'll talk about why that model benefits the advisors more so than it does the actual client. And you'll see this if you have 401ks or just Vanguard target date retirement funds. You'll see this increasing allocation of bonds and why it's actually a problem for clients, even though it's better for the advisor's model. In part 3, we'll be talking about what is protected investing and why does it have higher after-tax returns and less volatility than bonds. So in this earlier parts of the presentation, we'll be talking about how bonds have less volatility, but they're also lower earning and less tax efficient. Well, protected investing offers, a win in both worlds, right? You're getting higher after-tax returns and less volatility. So we'll be talking about why you really should look at protected investing in place of bonds in part 3. And part 4 is probably, the most interesting part of the presentation and something that, everyone should be utilizing is why is borrowing against my stock portfolio in retirement more valuable than taxable withdrawals? And so this is going to be a key element because if you're looking to retire early or maximize the wealth you pass on to beneficiaries, this is a key component because the traditional retirement model of over allocating the bonds, lowers returns, increases taxes. And then when you take taxable withdrawals, it really creates a lot of drag, as we'll be seeing in our case example. So using a pure stock portfolio and borrowing against it for your withdrawals in retirement can both generate a lot more wealth for you in retirement, generates a lot more wealth for your beneficiaries after you pass on. And reduces the overall tax drag of the portfolio. So we'll talk about why this is a huge key advantage you should be using. Finally, we'll talk about how you can pay 0% in taxes in retirement. Again, this will be in part 4. So if you do have large gains and if you do want to use taxable withdrawals, right, instead of borrowing, then you really should plan it. Use proper financial planning and take it out when you're at a 0% tax bracket. We'll talk about the importance of doing that later on. As I mentioned, I'm the chief actuary of both Colva Actuarial Services and Colva Capital. Colva Actuarial Services is an actuarial and insurance servicing company. that really works with high net worth clients and registered investment advisors or financial advisors. And we really we're the math guys to show them how to utilize better after tax, after advisory fee returns for their clients, right? How do we use protected investment vehicles to better enhance their clients' portfolio returns, right? So just a lot of education about math and kind of vehicles and showing them why it makes sense for the client. Colville Capital is a registered investment advisory firm. We help investment groups invest in alternative assets. So if you're looking at markets and you're seeing both stocks and bonds, have decreases, and you want to diversify your portfolio with alternative assets, we help registered investment advisors and high net worth individuals accomplish those goals of better portfolio diversification. Also implementing more tax efficient vehicles for their high net worth clients. So now let's talk about the use of bonds in a portfolio. Before we get into that, just for everybody, I'm not sure what your level is of investing. Bonds are, when you invest in bonds, you're simply lending money to a company in exchange for interest payments over time, right? So if in the opposite example, if you have a mortgage, you're borrowing, right, from a company, which is the bank, and then you're paying interest on that. This is the reverse, right? In this case, you're the one doing the lending. You're essentially the bank. You're giving money to the company, and they're giving you interest payments over time. So the benefits of bonds in a portfolio are they're less volatile than stocks. And when I say less volatile, that means you'll see less up and down movements in the portfolio if you're investing in bonds. We'll show that in a graph later on. Another benefit is that in the right environments, not in the current environment we're in, but it can add diversification to a stock portfolio in high yield environments, right? Not in low yield rising environments, which we're in now. So you're seeing losses in both bonds and stocks. The other advantage of bonds in a portfolio is that it provides steady yearly income stream, right? So you're getting a steady coupon payment and cash coming in. You're not kind of investing purely for the long term. You're getting yield essentially. So now let's talk about the disadvantages of having bonds in a portfolio. Well, the first and main one is that it's lower expected returns than stocks. So over the long term. So we'll be seeing this in the next few slides. So you have lower expected returns, but in exchange, you're getting the lower volatility. So you're not seeing it go up and down as much, but you're also getting lower returns, right? So that's the pro and con. You're getting a benefit of less volatility, but the con is that there's lower returns, right? Another con is that you pay taxes every year on the gain. So you're not really getting tax deferral if you're investing in bonds, of course, unless it's in a tax deferred retirement account. So again, there's two huge knocks, is that it's lower returns and you're paying more taxes on the gains than if you were to invest in stocks. Again, these taxes are subject to your ordinary income rate. So if you're a high earner in a high, tax state like California, you can be paying 50% or more on these taxes on an already lower yielding asset, right? So again, you're paying more in taxes on a lower yielding asset. It's not adding as much benefit to your portfolio. And of course, it will lose money. Investing in bonds will lose money if interest rates rise. So it's not a guaranteed safe investment. It is subject to losses. And so when you combine all these three things, it creates a drag on the portfolio, as we'll be seeing in a second. So just to summarize, bond investing has lower volatility, but also lower expected after-tax returns. So now let's go on and talking about stocks, the pros and cons of including stocks in your portfolio. First, let's just talk about what are stocks, or essentially equity. And when you invest in stocks, it's different than bonds, right? You're not lending money. You're essentially owning a small part of a larger company. So let's talk about the benefits of stocks in a portfolio. The first is that you're having higher long-term returns, right, than bonds. And again, we'll show the graphs later. The next key point is that you can defer taxes until you sell the stock or realize gains. And then there's a huge benefit of tax deferral, which we'll show again later on, that you don't really get with bonds. Another huge advantage is that there's a lower long-term capital gains tax rate. Again, it can be anywhere from as low as 0% to 37.1% currently in California. Again, the higher income you're earning, the higher tax rate you're going to be in. And the risks of investing in stocks can be diversified by buying multiple stocks, or known as index investing. So now let's talk about the disadvantage of stocks in portfolio. So when you invest in stocks, there's higher short-term risk. So again, there's more volatility, so the price can go up and down a lot. So if you're investing for the short term, it's can be very risky, right? Long term, not as much, but um, again, you're getting the advantage of higher long-term returns, but you're paying the price with the higher volatility relative to bonds. Um, so when we compare stocks to bonds, stock investing has higher long-term returns than bonds and are extremely tax efficient, but investors have to be okay with short-term volatility and investing for the long term. So the next step of this presentation is essentially to look at both stocks and bonds in two environments. One is kind of a subdued environment, or where stocks aren't doing too well, and then we'll look at it in a what's called a bull market, or an environment where stocks are doing really well. So I've chosen two periods here. One is a subdued, volatile equity market. I'll be looking at, or we'll be looking at the period between 2002 to 2011, where stocks, didn't do all that great. And then after that, we'll be looking at, 2012 to 2021, where stocks really did well. We'll see the differences in the key, the pros and cons we talked about in the previous slide will really come to light here. So just real quick, we have a graph of between 2002 and 2011. The stocks are, is the blue line. We're just tying it to the index with the S&P 500, which is the total return. You can follow this yourself if you want. You can get the data. The ticker is VOO. The bonds, we're just tying to the AG, which is just a bond benchmark. And that's in red here. And a couple key things, if you're just interested in portfolio management, you should always tie your returns to benchmarks. So your equity return should be tied to a benchmark like the S&P 500. Your bond return should be tied to the AG, something like the AG. So it's a good way to kind of, evaluate, your financial advisor or your investment portfolio and evaluate those returns relative to a benchmark. So the first thing we're going to see we're going to look at stocks first. We can see that stocks, in the early 2000s, didn't do too well. Like was in 2002 was, the loss was greater than 20%, right? So it was negative. Then we can see a huge jump in 2003, and then we can kind of see, obviously, in 2008 there was a huge, the financial crisis, and then 2009 jumped back up. So we're seeing that stocks go, the what we call the volatility as it goes up and down is high, right? And it's being hurt a lot by this huge loss here in 2008. So when you look at stocks, from the period of 2002 to 2011, again we're using the VOO as the benchmark. The pre-tax return was only 2.7% during this period, this 10-year period. And obviously it's low because of this huge loss here in 2008. And then again, the volatility is just a measure of how much it goes up and down as a percent. So this 20.57%, again, higher number here means it jumps up and down a lot, which we can see it goes up and down with a lot of volatility, especially due to this 2008. The Sortino ratio is just a way of measuring, return relative to risk. So we can see here in this, again, the higher number here means there's higher return relative to the risk. The lower return means there's lower return relative to the risk. So in this case, the 0.05 means that the risk is a lot higher than the return, right, on a value basis. And again, this is pre-tax. When we look at bonds, again, the red line, what we see is that the returns are a lot lower, but guess what? It's also more stable, right? It's, again, under 10%, never going above 10%. But again, you're not seeing the huge losses either, right? So if we look at the pre-tax return over this period, we can see that the bonds are about 5.51%. The volatility, look how low the volatility is. It didn't, it's not hugely aggressive here. It's not jumping up and down a lot. It's very low. So when we look at the return relative to the risk, it's 2.23, which is significantly higher than stocks over this period. So just to summarize, in a subdued equity market, volatility can hurt portfolio drastically, right? So if it's going up and down, like especially if you have huge losses like we did in 2008, it can really hurt your portfolio. Another thing is that in a higher interest rate environment, like we were in 2002 to 2011, bonds can add value to your portfolio. They can be a good diversifier of risk and provide stability in your portfolio. So now let's look at a period when stocks did really, really, really well. So stocks and bonds in a bull equity / low interest rate decade, right? So here we're looking at 2012 to 2021. We're looking at stocks and bonds, and we're going to do the same comparison. We're looking at the S&P 500 as our benchmark, and bond returns are the ag, again, the red line. So the first thing we're seeing is that, stocks from 2012 to 2021 barely have any negative years. It's really just 2018 where it did negative. It was slightly negative. So it's a huge bull run. So if you were invested in stocks, you did really, really well over this period. And this is reflected in these metrics over here. From 2012 to 2021 on a pre-tax basis, stocks, the VU was about 16.39%. The volatility was 12%, which was significantly less than what it was in the previous decade, right? So when we look at our Sortino ratio, it's high, it's humongous. The return relative to risk is huge over this period. Bonds are another story. Bonds, the interest rates were low during this period, and the reason why is because the Fed, purposely suppressed interest rates so that the economy did well. So it accomplished that goal, right? They kept interest rates low, which means everybody wanted to invest in the stock market because interest rates were too low. So it was a great alternative. But the downside is that bonds really didn't have much value, right? So again, we see lower volatility, but the returns are really low too. 2.81% on a pre-tax, compounded basis. Again, the volatility is low, but when we look at our Sortino ratio, which is our return relative to risk, it's really low. So it's the reverse of what we saw in the previous decade, right? So the key things to take away here are that in a bull market, stocks vastly outperform bonds, so the volatility is worth it. So this volatility is well worth it for these returns, right? And low-yielding bonds are easy to outperform, right? The interest rates were held low, so the alternative was to invest in stocks, and stocks took off, largely because of the low interest rate environment. So now let's look again at let's put everything together. Look over the entire 2002 to 2021 period, again, just on a pre-tax basis. We can see stocks are, again, volatile. A huge loss in 2008, but up and down, large up and down from year to year. We see lots of volatility. Bonds, again, are more stable. So when we look at this, we're essentially seeing the entire period stocks, over the 2002, if you're investing for the long term, you made about 9.33%. This was the volatility here. Again, the pre-tax Sortino ratio is 0.69 because, again, you had the good decade or the bad decade, and then you had the great decade, right? Bonds, you had the opposite. They had the good decade and they had the bad decade. So here's the risk relative to the return. Again, you're getting more return here with stocks, but again, you're taking more risk. Bonds, you're getting less return, but you're getting less risk. So, stock investing over the long term has higher returns, but you have as we'll talk about later, are more tax efficient. But you have to be okay with this volatility. So in subsequent sections, we'll be talking about, well, how do I minimize the risk part of it? You kind of want the best of both worlds. You want the higher returns, but you don't want as much risk. So how can we kind of compromise and get a portfolio solution that makes sense for us and our risk tolerance?